Jacob, help us get some perspective on how deep this recession is expected to be versus others then. Give us some numbers.
So, well, first up, we're scaling this off what we've seen in China in the first 2 months of the year. 25% down in investment, 20% down retail sales, 15% industrial production. And that's with really a basically untouched January. We think 5% quarterly decline in China in the first quarter, 4% in the US in the second, 5% annualized fall in Europe, the epicenter of the epidemic over the year. To give you some perspective, this is a little bit less bad than the GFC, but substantially worse than, for instance, what we saw in 2001. And I think the way you describe it is this is sharper. We fall further, but we should bounce back quicker. We just don't make up the area under the curve that we lost. Because it's mainly
yes,
services.
We heard that from the Bank of...
we didn't pay.
Yes, we heard that from the Bank of England governor, the new Bank of England governor, Andrew Bailey. He was saying it should be temporary. What is temporary, Jacob? What do we know yet about how China is recovering that tells us how temporary this can be?
Well, you know, outside Hubei, we're more or less back to work. And so that the lockdown in Hubei was 23rd of January, a little bit later across the rest of the country. So where you don't have, a cluster spreading, but you're just sort of picking up odd cases and small clusters from elsewhere, you can get on top of this thing in about 6 weeks. I think that if you have a cluster that's sort of spreading exponentially, as we're seeing in, obviously, France, Spain, Italy, arguably across Europe, it's going to be a longer shutdown. We're still assuming that this is, the number of cases are falling by mid-May, that new cases are falling from early May. But this is a first-half phenomenon, not a long-running epidemic, not a W where we have another outbreak in the autumn. So it is, I think, not a worst-case scenario. We've got a bear case too, if you want it.
Yes, indeed. I've just been looking at the global infection curves and how it's been steepening. I'm looking at how we did in China, how we did in Korea, Iran, Italy, and now into Europe and the US. The trouble, I suppose, now we're into the US and Europe, is that these are services economies to a large degree, and this is very different to China. So what do we need to keep in mind about that, Jacob?
Well, I mean, that's the point, really, is that obviously if you're a manufacturing-dominated economy, you've got stockpiles you can sell while your factories are shut for the virus. So you can maintain sales to a greater extent through the crisis. If you're services, it's very difficult to sell a lot of your services if people can't come to consume them. And it's difficult to catch up on the other side. So you're going to have this sort of liquidity crisis where a lot of businesses are going to be generating no cash, but they may be solvent, viable businesses, and that's where the policymakers have to step up to support them so that when we come out the other side, we haven't lost a lot of those viable businesses.